In this week's video, we'll answer the question, what are the odds a bear market has already started in 2015? We've got a lot to cover, so we'll move quickly. We'll start with bear market transitions versus the present day, Triple Crown update, go over the S&P 500 and global stocks as of the close on Friday. A quick reminder, we're looking at bear market probabilities here. That does not mean a garden variety correction cannot occur. Corrections are always a possibility. The evidence determines how quickly the model reduces risk. Why is that important? The model does not need to differentiate between a correction and a bear market. If things get ugly, and if things get ugly in a rapid manner, the model will move away at a more rapid pace. Why are we looking at price and trends? Price and trends reflect all known inputs, including Greece, weak GDP, earnings. Price is well aware of the divergence in the transports, and price is well aware of the strong US dollar. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we look at bear market transitions, let's explain some simple concepts and then we'll come back to this chart. We'll kick off the video with some basic concepts and we'll use the concepts on every single chart that follows. So bear with me if you're a regular viewer. This is short-term bonds relative to the S&P 500 in 2008. This is price here. When the ratio is rising, it tells us that the conviction to be in short-term bonds is greater than the conviction to be in growth-oriented stocks. The moving averages help us with probabilities and trends. This is a full-bore bullish look in favor of defensive short-term bonds, where price is above both moving averages, blue is above red, and the slopes of both are up. Conversely, this is one extreme, this is the other extreme. In 2009, as the stock market begins to bottom here in March, we get a bearish moving average crossover against bonds and in favor of the S&P 500. This is a full-bore bearish look where price is below both moving averages, blue is below red, and the slopes of both are down. This tells us that the probability of bad things happening is higher here than it was here, and this tells us that the probability of good things happening for bonds relative to stocks is higher here than it was here. How does the same exact ratio with the exact same moving averages look today? The answer, as of the close on Friday, May 29th, the ratio looks a lot more like a risk-on period that began in March of 2009. The present day really doesn't look anything like this or this. If this chart morphs into something like this, then the evidence will begin to change and the model will make adjustments. We're not going to anticipate what happens. We need to see incremental changes on this chart. The previous charts were weekly charts. Now we'll use the same concepts with a blue moving average, which is the faster moving average, and a red moving average, which is the slower moving average on a daily chart of the S&P 500. We'll be using the 50-day and the 200-day for illustrative purposes only. They're commonly used moving averages and everyone understands them. The 50-day helps us with the intermediate term trend, and the 200-day helps us with the longer term trend. You can see the S&P 500 here. We get 1, 2, 3 rollovers in the 50-day, telling us that the intermediate term trend is starting to wane. And notice the white space between the two moving averages starts to close here, telling us that risks are increasing. If we extend the chart, it gives us a good visual of what a transition from a bull to a bear looks like. Again, using the same concepts from the weekly charts. Here, blue is above red. We get a bearish cross here. We have the slope of the 200-day rolling over here. Blue below red, and the slopes of both are down. We can see all of those things in December of 2007. Then we come up and retest the long-term trend here and fail. This is a bad sign. The slope starts to roll over again. Blue is below red, price is below. Here's full bore bearish look again in this region here. This rejection takes place at 1426, very early in the process, and we get the full bore bearish look in December of 2007 with the S&P trading at 1496. As we know, this is our higher risk look here, and indeed bad things did happen. How do the same moving averages look on the same chart today? The answer is much better. In fact, price has not even dropped below the 50-day moving average yet. So we might have a look like this, or maybe even a look like this. Notice the white space between the two moving averages and the slopes of the moving averages. We look more like this period here or this period here than this period in here where risks start to increase. Moral of the story is, if a bear market is on the horizon, and that very well may be the case, we may have peaked right here. If that's the case, the odds are that it will take more time to transition from the present day look to a look more like this. We don't need to know that in advance. If we move quickly from a look like this to a look like this, that means the math will deteriorate at a faster rate and the model will reduce risk at a faster rate. We'll make decisions based upon observable evidence. This chart, as of the close on Friday, May 29th, just doesn't look that bad yet. Chris, the financial crisis was a one-time event. Okay, let's look at the dot-com bust. There's also a transition that takes place, white space, rollover, rollover, rollover. And then here in the year 2000, in November, we get a full-bore bearish look. Price is below both moving averages, blue is below red, and the slopes of both are rolling over. The point of the exercise is this is observable. I can see it before this happens. Notice during the bear market, for the most part, we stay in the full-bore bearish look mode with price below. We get some rallies here, but during the bear, the slope of the 200 never turns up, and we never get the bullish moving average crossover where blue goes above red. If the present day starts to morph into a look like this, our concerns will increase. The present day looks more like it is susceptible to a correction rather than a bear market, but we don't need to predict that in advance. We just need to pay attention to the observable evidence. This is the year 2000 here. How does the same chart look today? The answer is much better. All of these incremental changes take place. Here, when the S&P 500 is trading at 1421, we have a full-bore bearish look. The S&P dropped from 1421 all the way down to 775, telling us that yellow flags were waving before this 45% decline. Remember, we said we were using the 50 and the 200 for illustrative purposes only. They're not foolproof. In fact, nothing is foolproof. That's why the market model diversifies and uses numerous inputs. Here's another set of moving averages, daily moving averages used by the market model in order to diversify. Blue is always the fastest moving average on these charts, and the same concepts apply. Here, we have blue below all the other moving averages, and the slopes of all of them are down on November 21st, 2007. How do the exact same moving averages look today? The answer is much better. We still have a full-bore bullish look. Price has been moving sideways, telling us that the vulnerabilities are increasing here. If we want to compare apples to apples and take price out of the equation, present day look tells us that risks today are quite a bit lower than they were here. It doesn't mean risk has been taken out of the equation. It's just from a probability perspective, we're in better shape here than we were here from a bear market perspective. Same concepts, we're just using a different set of daily moving averages. Got a warning here, early January 2008, and another one here in July of 2008. Notice blue drops below. The slopes of all the moving averages are down prior to this big plunge in equity prices. How do the same moving averages look on the same chart today? The answer is much better. Price has been consolidating, but as you can see, it really has not done significant damage to the trends yet. If we take price out of the equation, allowing us to compare apples to apples, you can see the present day really doesn't look anything like this period here or this period here. Now we're moving to weekly moving averages, identical concepts. Our fastest moving average, you can see here in 2007, we get a discernible lower high in the blue moving average, telling us that the trend is weakening, and we have a full bore bearish look here and a break of moving average support. This is a big yellow flag. How do the exact same moving averages look today? The answer is much better, telling us that the probability of a bear market forming right out of this formation is not zero. It's never zero, but it's relatively low. We might see something like this where we have some type of correction and come back up. No predictions needed. We'll take it day by day. Pay attention to the math. What the model does is it says, based on what we know today, the facts, are we allocated prudently? If the answer is yes, leave it alone. If the answer is no, then we make incremental adjustments. If we remove price, we can do the apples to apples. This looks better than this or this. We can look at trends with moving averages as well. Our 3 steps for a trend change: broke a trend line, made a lower high, step 2, and then made a lower low. This is a big red flag here. We don't have any of that today. We may see it, but we don't anticipate it. The same concepts can be used with risk on versus risk off ratios. Stocks relative to more defensive bonds. We get a full bore bearish look here on the monthly chart. This is the S&P 500 after bad things start to happen here that we can see. Bad things happen in the S&P 500. We can see this here after that bad things happen. A lower high here as the stock market makes a higher high. A lower high in the ratio here as the stock market makes a higher high. How does the exact same ratio look today using the exact same moving averages? The answer is significantly better. Instead of making a lower high, the ratio just printed, and it's in the books, trading month is over, a higher high, a higher closing high on the exact same chart. We have a full bore bullish look in favor of stocks. So on this chart, some things need to happen to morph into a bearish look. That may happen, but we need to see it. Now we're looking at the Dow Jones Global Stock Index in 2007 here. Remember, we're talking about bear market probabilities. This doesn't look too bad here, and yet we get a sharp correction. But it also helps us with the concept of a strong trend tends to try to bounce back. We get a sharp correction, but the profile looks relatively healthy here. Buyers step in, and we go on to make a higher high. The moving averages help us here. They're rolling over, rejected. Bad things happen again. Here, prices below, we get the bearish moving average crossovers. After this, awful things happen. These are the exact same moving averages as of the close on May 29th, 2015. Again, we can get a correction out of a look like this, but the probabilities are relatively low that we're in a situation like this or this. This is what fear looks like in 2008. This is what confidence looks like. I'd rather be in the S&P 500 than defensive consumer staples. Does today look like confidence or fear? As of the close on Friday, May 29th, the weekly ratio, just made a lower low on a closing basis and has a full-bore bearish look against defensive consumer staples relative to more growth-oriented and diversified SPY. If we take the moving averages out of the equation and just focus on price, 2007, we make a discernible lower high and a discernible lower low as we move into a downtrend. Multi-month correction in 2011, lower highs, a discernible lower high, a lower low, and another lower low, and then stocks correct for several more weeks. Do we have any of this today? The answer is no. The last thing the S&P 500 did, this is a daily chart as of the close on Friday, May 29th, was make a discernible higher high. We haven't even taken out this low here yet. This was the low on Tuesday, the first trading day of the week. This is the close on Friday. For the bears to make progress, a baby step is taken if we can get a close below 2100, and these levels down here are more important. 2067 here, 2064 acted as resistance and may now act as support. This trend channel also comes into play in this general area here, telling us that taking out this low at 2039 is the one of greater concern. If you're a client, just be aware, the longer we move in somewhat of a consolidating fashion, the more vulnerable the math becomes. If we break 2039, the model will have us run away at a very rapid pace. If we can stay above these levels here, if we make changes, they would be relatively small. The rules are not based only on price. There's an ETF scoring system that looks at our individual holdings, and there are rules there as well. Key level, 2039. If it's taken out, the odds are extremely high that the rules will call for incremental risk reduction, and the probability of a correction starts to increase exponentially if we get into this area here. Keeping regular viewers up to date, this is our full-bore bearish look in 2008, full-bore bullish look. Here we have somewhat of a mixed bag. What once was resistance may now act as support, telling us we have weekly support somewhere in the 2105 to 2100 range as well. All support is possible support. We can summarize with some longer duration moving averages. Here's your transition. Here, blue is on top. The slopes of the moving averages are up. Here, price is below all of them. Now blue is on the bottom and the slopes of all of them are down. This is a lower risk look than this, and this is a lower risk look than this with the tight moving averages. This is a favorable look here. How does the present day look? Much better. Regular viewers may remember there are 38 bad things that can happen on this chart. How many of them have happened as of the close on Friday, May 29th? The answer is 0. As always, we'll head into next week with a flexible, unbiased, and open mind. The markets and price will guide us if we're willing to listen. And it is possible that this begins to morph into something more like this. We won't anticipate that. We'll pay attention and adjust as needed. Remember, one of our key points, if the S&P 500 goes on to correct for 3 months, 3 weeks, or 3 years. One thing we know with 100% certainty, especially relative to a bear market: we cannot go into a bear market if the S&P 500 never closes below 2039. This is a guidepost that we'll be using next week. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.